The White House quietly exempted computers and phones from reciprocal import tariffs on Friday night after the market closed. But a Trump official then suggested this morning that exemption may be temporary. US consumer confidence slumps and gold hits another record high. That's coming up in our 5 Things in 5 Minutes on Monday, April the 14th. And in today's bonus deep dive interview, ANZ's senior commodities strategist Daniel Hynes explains why oil prices have fallen more than 15% in the last fortnight.
Well, in simple terms, it was Trump and his tariff tirade which really drove prices lower. Certainly the prospect of these rising tariffs and trade tensions, particularly with China, is raising concerns about what it means for oil demand.
But first, in 5 and 5 with ANZ, the White House quietly exempted computers and phones from reciprocal import tariffs on Friday night. That was after the S&P 500 had closed up 1.8% because a US Federal Reserve official said the Fed would intervene in markets if necessary to restore stability. But markets may not be able to celebrate too much this morning in Asian trade after US Treasury Secretary Howard Lutnick said the exemption for imports on computers and phones from China would only be temporary and that a specific tariff on computer chips was coming soon. He said Trump ultimately wanted these devices made in America. ANZ Group Chief Economist Richard Yetzinger says this exemption was Trump's second big pivot after last week's suspension of reciprocal tariffs beyond China.
President Trump's, you would say, back down now for the second time in a week, exempting electronics from his punitive tariffs on China. And I think we can use the word punitive because to close the week, China announced escalatory tariffs, but then stated that because tariffs between the two economies were essentially at levels that trade would all but cease, that they weren't going to follow any future US escalation. If Trump wants to do deals by backing people into a corner, he has overreached twice now on the basis that he's then backed back. So it seems like Trump is the one doing more deals than other economies.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was down 0.7%. The Aussie dollar was up 1% at 62.85 US cents, and the Kiwi was up 1.5% at 58.24 US cents. More on gold and oil later. Number 2. Richard says the bond market's volatility is a major factor putting pressure on Trump. The US 10-year yield closed up 7 basis points at 4.49% on Friday before the latest pivot, having risen over the key 4.5% mark to as high as 4.59% in earlier trade. The 10-year yield, which is a key indicator in the global financial architecture, has risen as much as 66 basis points in the last week. The US 30-year yield has risen about the same amount, and on Friday that translated into the US 30-year fixed mortgage rates, the things that homebuyers use, rising 13 basis points to 7.1%. That's the highest level since February. Here's Richard.
The pressure is on the US administration because of the bond market, and the bond market. More parallels being drawn between President Trump and Prime Minister Liz Truss in the UK a handful of years ago, who upset the bond market with a fiscal proposition which the market felt was unfunded. In fact, successive UK governments and chancellors are still trying to find their feet to deliver fiscal plans without upsetting the bond market. So that genie really hasn't gone back in the bottle. And if I was in the US administration, I would be exceptionally concerned with the way the bond market is trading. And at face value, what it suggests is we'll have to see more concessions out of the US.
Number 3. US consumer confidence collapsed in early April, according to ANZ economist Bansi Madhavani, who reports from London.
The University of Michigan's preliminary April consumer confidence sentiment plunged as consumers are worried about what tariffs might mean for employment prospects and future outlook. More importantly, we are seeing early signs of inflation expectations spiraling. Consumer expectations of inflation over a 5 to 10 year horizon lifted to 4.4%. The near-term inflation expectations, which is over a 1 year horizon, spiked to 6.7%. That is the highest level since 1981.
Number 4. Gold closed at another record high, $3,244 an ounce on Friday night. It's all about safe haven demand, says ANZ senior commodities strategist Daniel Hynes.
Gold has a very, very long history of providing a bit of a backstop. I mean, you go back to the gold standard and it was essentially setting the price for US dollars and global currencies. So it has a very long and very strong and long sort of career or history of supporting the financial system.
Number 5. The US dollar status as the world's reserve currency is now openly in question, although ANZ currency strategist Felix Ryan says it's too early to call time of death yet.
in terms of the reserve status of the US dollar, of a reserve system changes over a long period of time. It's not something that happens in the span of a few weeks, let alone a few years. So that in itself doesn't seem to be in jeopardy just at this stage. Really what's driving the dollar lower at the moment is just those concerns around the growth outlook and the impact that tariffs may have on the US economy.
Felix Ryan there. Now, in today's bonus deep dive interview, ANZ senior commodities strategist Daniel Hynes explains why oil prices have fallen more than 15% in the last fortnight.
Well, in simple terms, it was Trump and his tariff tirade, I suppose, which really drove prices lower. I mean, it clearly is a commodity which is sensitive to the economic outlook, and certainly the prospect of these rising tariffs and trade tensions, particularly with China, is raising concerns about what it means for oil demand. I think for oil, it was a bit of a perfect storm because there was also some supply side issues bubbling away in the market, namely OPEC's move to essentially accelerate the output of production that it originally agreed to proceed with a long period of time. This was, I think, in sort of a retaliation for, those overproducing countries which haven't really stuck to their quotas over the past little while. So we're in a perfect storm where supply is rising just as the prospects for demand come under serious question marks. And so we saw a pretty sharp sell-off exacerbated by this sort of risk-off tone across all global markets. So oil suffering as a consequence.
Could you tell us about the situation in Kazakhstan where Chevron and Exxon have a joint venture and are planning to increase production, and how Saudi Arabia views this and what it's doing about it?
Yeah, so one of the main culprits of the overproducing issue has been Kazakhstan. They've undertaken some new expansions in recent years, and some of these have been essentially financed by international operators such as Chevron. And the Kazakhstani government are struggling to get those international players on board to adhere to the agreed production levels that they entered into with the broader OPEC group. Now, Saudi Arabia, who is the de facto leader of OPEC, has been shouldering a lot of the work around keeping OPEC production under the broader sort of planned levels. And so it come to the idea that these overproducing nations need to pull their weight a little bit more. So we're getting this reaction from Saudi Arabia in particular to potentially force them to cut by essentially flooding the market with a bit more oil and pushing the price lower. So it's a bit of a power play, I suppose, within OPEC itself, which has obviously global complications because it's going to weaken oil balances and push prices even lower than they would have been, despite obviously the issues around the global economic outlook.
How sensitive is the oil price, given that supply backdrop, how sensitive is it to a slowing of world growth, particularly, under that 3% mark?
Yeah, well, the IMF does class a global recession as world GDP falling below that level, and we would potentially see at least a sort of a 1% fall in oil on an annual basis. That's opposed to the 1.5% to 2% growth that we're expecting to see in the current calendar year. So it would be quite a significant shift, clearly pushing oil balances, as I said, into surplus, would see inventories start to build. It would be quite a shock. It's certainly a level or a fall that we really haven't seen outside of some pretty significant sort of periods, for example, the financial crisis of 2008 and even COVID, where we did see falls in oil demand as well. So negative growth is not a common occurrence for oil, so such an event would be quite significant.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, April the 14th. Catch you tomorrow with the latest tariff news and analysis of the Monetary Authority of Singapore's policy decision due later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.